Quant's biggest advantage? They got rid of the weakest link in trading, their own brain. If you could remove you and your emotions from the equation, you'd be so much more profitable. Here's what nobody will tell you about trading. Your brain wasn't designed for trading. It evolved to keep you alive on the savannah, not to make probabilistic decisions in financial markets. And every single day, those ancient survival instincts are sabotaging your account. Loss aversion makes you hold losers and cut winners. Recency bias makes you overtrade after wins and freeze after losses. Overconfidence makes you risk too much. Meanwhile, the average quant is crushing it, not because they're smarter than you, but because they've systematically removed human psychology from their trading. They automated away the problem you're still struggling with. And here's the kicker. You can't fully automate your trading like they do, but you can steal their psychological frameworks. That's what this video is about. Retail traders fight the market. Quants fight the math. You wake up, check positions, scan setups, watch every tick. Hundreds of micro decisions. Should I enter? Exit? Add size? Every moment, your biology sabotages you. You're fighting the market with your brain and losing. Quants don't fight the market at all. They fight a completely different battle against data and probability. They spend months developing a system, testing it against years of data, finding that small edge, 52% win rate instead of 50%. Average wins 20% bigger than losses. Then they program it. Entry rules, exits, position sizing, risk, everything automated. When it goes live, no decisions to make. The computer monitors. Conditions match, it executes. No fear, no hesitation. The quant just makes sure it's running. See the difference? They fought their battle once, when they were calm and rational. Now, they just collect results over thousands of trades. The invisible enemy has nothing to attack because there's no human making emotional decisions. You're fighting individual battles while your biology sabotages you constantly. They won their war once, automated it, and now just execute. When a retail trader enters a position, they're trying to predict what happens next. They won't be right. They need to know this trade will work. A quant? They don't predict anything. They assign probabilities. They ask, if I take this setup 100 times, what's my expected value? Think about that difference. You're playing a completely different game than they are. Here's an example. A quant finds a pattern that wins 55% of the time. Average winner, $110. Average loser, $100. Most retail traders would call that mediocre. Only 55%? I need something better. But run the math, and you'll get a net profit of $1,550 on 100 trades. That's a money printer. But you'd never stick with it because you'd hit a string of 5 losses in a row, panic, and abandon it. See, quants aren't trying to win every trade. They're trying to have positive expected value over large samples. They're comfortable being wrong because they know the math works out. You need to make that same mental shift. Stop trying to predict. Start thinking in probabilities. Every trade is just one flip of a weighted coin. You can't control the outcome. You can only control whether you're flipping coins with favorable odds. Here's where it gets interesting. Quant are obsessed with process. Everything is documented. Entry rules, exit rules, position sizing, risk parameters. All defined before they risk a dollar. When they take a loss, they don't ask, why did I lose money? They ask, did I follow my process correctly? If yes, the loss is irrelevant. It's just statistical noise. If no, that's the problem, regardless of whether the trade made money. Retail traders do the exact opposite. They judge success by individual trade outcomes. Let me give you a scenario. You have a rule, risk 1% per trade maximum. You see a setup you really like, so you risk 3% because you're extra confident. The trade wins. You made money. Most people would celebrate, but you just failed. Hard. You violated your risk management. The fact that it worked was luck, not skill. And worse, you just trained your brain that breaking rules leads to rewards. Now you're more likely to do it again. Next time you might not be lucky. You risk 3%, it loses, and suddenly you're down 3 times what you should be. But the real damage is deeper. You've destroyed trust in your own system. Quants can't make this mistake. Their systems can't get extra confident. They follow the exact same rules every single time. That consistency is what allows edges to compound. Your job isn't to be smart on every trade. Your job is to execute your process consistently and let the statistics play out. Grade yourself on execution, not outcomes. That's the shift. Removing discretion. Most retail traders use way too much discretion when trading. They have general guidelines, but then they make judgment calls on everything. This setup looks pretty good, but maybe I'll wait for more confirmation. Actually, you know what? I'll just take it. That feels like flexibility, like you're adapting to market conditions. But really, it's just your emotions hijacking your decisions in real time. Every discretionary choice is an opportunity for fear or greed to steer you wrong. You skip good setups when you're scared. You take trash setups when you're desperate to make back losses or feeling overconfident. Quants figure out humans can't be trusted under pressure. So they define the rules when they're calm and rational. Then they follow those rules mechanically when the pressure's on. It's like Ulysses tying himself to the mast so he could hear the sirens without being lured to his death. Your calm self creates rules that your stressed self must follow. Here's a practical test. Look at your last 20 trades. How many did you take exactly according to a predefined plan? Most people realize they're improvising on almost every trade. That's not expertise. That's just inconsistency wearing a disguise. The more specific your rules, the less room for emotions to mess with you. Not, I'll buy when there's momentum, but I'll enter when price closes above the 20 MA with RSI above 50 and volume above the 30-day average. Specific, mechanical, repeatable. That's how you remove emotion from the equation. Here's a massive psychological difference. How losses are perceived. When you lose money, it feels personal. You replay the trade in your head. You beat yourself up. You question everything. When a quant system loses money, it's just data, information about system performance. Losses aren't failures. They're not even mistakes. They're the cost of doing business in a probabilistic environment. Think about a casino. Someone wins at blackjack. Does the casino panic? Question their entire business model? Of course not. They know individual outcomes are random, but the math is on their side long term. That's exactly how quants view losses. Expected, even necessary. What matters is the overall expected value over thousands of trades. But there's more to it. Quants study their losses systematically. They ask, was this within expected parameters? Are we seeing more frequent losses than the backtest suggested? Is there a pattern to when these occur? Analytical questions, not emotional ones. Before you enter any trade, decide what you'll learn if it loses. Not vague, I'll see what went wrong, but specifically, what information will this trade give you? Maybe you're testing if a setup works in current conditions. If it loses, you've learned something about the market environment. That's valuable data. Or you're testing your discipline. You follow your rules perfectly and the trade loses. You actually succeeded at the thing you control. Outcome was negative, execution was positive. This reframing is powerful. It shifts losses from emotional events to informational ones. And when you stop fearing losses so much, you stop doing desperate things to avoid them. You stop moving stops. You stop holding losers hoping they come back. You stop revenge trading. You just take the loss, record it, and move on. Accept the randomness. Hard truth. Short-term results are mostly random. You need to be okay with that. Quants know you can't predict the next hour or day with any real accuracy. What you can do is find patterns with slight statistical edges over thousands of occurrences. We're talking 52% probability instead of 50%. That's enough to make millions over thousands of trades. But on any single trade, you're flipping a slightly weighted coin. Retail traders want certainty. They torture themselves trying to find the perfect entry that can't fail. That setup doesn't exist. Every trade can fail. The market is influenced by millions of participants making decisions based on countless variables. There's genuine randomness baked in. You can't predict it. Stop trying. This doesn't mean analysis is useless. It means your analysis should focus on finding small edges that play out over time, not predicting individual outcomes. Here's an analogy. You can't predict the next coin flip. But if I flip a coin 1,000 times, you can predict with high confidence I'll get between 450 to 550 heads. Long-term is predictable. Short-term is random. Same with trading. You can't predict your next trade. But with an edge and consistency, you can predict what 100 trades will look like. The psychological challenge? Your brain hates this. It wants stories and certainties. When a trade moves against you, your brain screams for you to do something. But sometimes the right answer is, this is just random price movement, and you should do nothing except follow your predetermined plan. This is why Quant sleeps soundly with positions on. They've accounted for the randomness. They've sized positions to handle it. They've set exits to manage it. You're up at 2 a.m. checking positions, stressed about every tick because you're treating each trade like it should have a predictable outcome. Let go of that. Make peace with randomness. Sample size thinking. Quants execute thousands of trades per year. At that scale, edges show up clearly. Randomness averages out. You might take 30 trades per month. At that scale, you can have a real edge and still lose money for a few months just for variance. Your sample size is too small. This creates a nightmare. You can do everything right and still look like you're failing. During that time, you'll think your system is broken. Statistically, everything's working exactly as expected. Quants experience the same variance, but their larger scale smooths it out faster. A bad day or week, sure, but over a month or quarter, the edge shows up. So what do? First, stop judging your system on short-term results. A month of losses means nothing. You need at least 100 trades before making any confident assessment. Second, resist tweaking after every loss or losing streak. Retail traders system hop constantly. Trade one way for weeks. It doesn't work. Switch to something else. Then that doesn't work. Switch again. You're restarting your sample size at 0 every few weeks. You never accumulate enough data to know if anything works. Quants develop a system, test it, deploy it, then leave it alone for extended periods. They monitor, but they're not constantly changing it. They need the sample size to build up. The discipline this requires is brutal. You need to trust your process even when it's losing. But you can't be so stubborn you ignore signs something's genuinely broken. Finding that balance? One of the hardest parts of trading. Mathematical risk management. Risk management is where emotions strike the hardest. Quants manage risk mathematically. They calculate exactly how much to risk based on overall parameters. They size positions precisely. They set stops at predetermined levels. Everything's calculated. Then they execute and don't touch it. The system manages risk. No emotional decisions needed. Retail traders manage risk emotionally. Price approaches your stop. You think, maybe I should give it more room. So you move it. Now you're risking more than planned. Why? Because taking the loss feels painful, and you'll do mental gymnastics to avoid pain. Or the opposite. You're winning, it pulls back slightly. You panic and exit early because you're afraid of giving back profits. You just destroyed your risk to reward ratio because of fear. Emotional risk management is a disaster. Your risk rules should be set before entering, when you're thinking clearly. Once you're in, your judgment is compromised. You have a rooting interest. You're no longer objective. This is why quants automate it. They don't trust themselves in the moment, so they don't give themselves the choice. You can apply this too. Before entering, decide, where's my stop? What position size? What's my target? Under what conditions will I exit early? Write it down. Commit to it. Then your job isn't to manage the trade. It's to enforce rules you already set. You're not making decisions anymore. You're executing a plan. This removes so much pressure. You don't need to figure out what to do in the moment. You already decided. Now you just need discipline to follow through. Here's a rule that'll save you. Never risk more than 1 to 2% per trade. Period. No exceptions. This alone keeps you in the game long enough to learn. Most traders blow up because they take on too much risk. 1 or 2 big losses and they're down 30 to 40%, which is psychologically devastating. Protect capital first. Profits follow. The detachment skill. One of the most powerful skills quants demonstrate. Emotional detachment from positions. Once a system enters a trade, there's no emotional attachment. No ego invested in being right. It executes the process and moves to the next opportunity. You get emotionally attached. You enter a position and suddenly you're rooting for it like your favorite sports team. You need it to win. Your self-esteem gets tied to whether it works. This clouds judgment. Makes you hold losers too long because admitting defeat hurts. Makes you exit winners early because you're scared of losing profit. Makes you check positions constantly, unable to focus on anything else. The irony? The more you care about any individual trade, the worse you'll perform. The emotional energy works against you. How do you develop detachment? First, understand that any single trade is meaningless. It's one data point in hundreds or thousands you'll take over your career. This specific trade doesn't matter. Sounds harsh when real money's on the line, but it's true. What matters is long-term process, not this particular trade. Second, proper risk management helps enormously. If you're risking 1%, detachment is much easier. If you're risking 10 to 20%, detachment is nearly impossible because stakes feel too high. Third, fill your time with other things. Don't sit watching every tick. Enter your trade, set stops and targets, then do something else. Let play out without constant attention. Quants do this naturally because they're not manually watching. The system runs while they do other things. They check performance metrics periodically, but they're not obsessing over individual positions. This isn't coldness. Quant care deeply about overall performance. They've just learned to care about the right things at the right level. They care whether their system performs as expected over meaningful time frames. They don't care whether any specific trade wins or loses. That's the distinction you need. Final point. Systematic approaches beat discretionary approaches long-term, and the main benefit is psychological. Systematic traders follow the same rules every time. This consistency allows edges to manifest over large samples. Discretionary traders make slightly different decisions every time based on feelings, recent experiences, current emotional state. This inconsistency makes it impossible to know if you have an edge. Think about it. If your results are driven by dozens of subtle judgment calls per trade, how do you know which help and which hurt? You can't isolate variables. Can't test anything. You're just a black box producing random results. Quant test everything. Isolate variables. Determine precisely what works. Optimize based on data, not feelings. You don't need to become fully algorithmic, but push yourself toward more systematic, rule-based approaches. Define setups clearly. Create specific entry and exit rules. Follow them consistently. Track results rigorously. Then, based on real data, make informed changes. The psychological benefit is huge. You remove constant second-guessing. You're not lying awake wondering if you should have done something different because you followed your rules. Either the rules work or they don't, and you'll figure that out over time with data. Compare this to discretionary trading where every trade is unique and handled differently. When you lose, you torture yourself wondering what you should have done. When you win, you're not even sure what you did right. This ambiguity is psychologically exhausting and makes improvement nearly impossible. Systems create clarity. Clarity reduces stress. Reduced stress leads to better decisions. Better decisions lead to better results. It's a virtuous cycle, but you have to commit. The uncomfortable truth. Here's what's probably going to happen. You'll finish this video feeling motivated. Yes, I need to focus on process and discipline and probabilistic thinking. Then you'll go back to trading, and within days or weeks, you'll fall back into old patterns. Trading on gut feelings, moving stops, risking too much on confident setups, abandoning your system after losses, searching for new strategies. Why? Because changing psychology is way harder than learning a new indicator. Your brain has been wiring these patterns for years. The way you handle uncertainty, deal with loss, respond to fear and greed, deeply ingrained. You can't change by just knowing you should change. You have to practice new patterns consistently until they become automatic. This is why most traders never make it. Not because they don't know what to do, because they can't consistently do what they know. Quants automated away the problem. You can't automate yourself, but you could train yourself. It just takes longer than you want, and it's harder than you think. But it's the only way. Here's the thing. You probably know enough technical analysis to be profitable already. What you're missing is psychological discipline to execute consistently. That's what separates the 5% who make money from a 95% who don't. The 5% aren't necessarily smarter. They've just developed psychological skills to trade their edge consistently without sabotaging themselves. You can become part of that 5%, but you have to do the work the other 95% won't do. Focus on boring things like consistency and discipline and process. Take losses without falling apart. Win without overconfidence. Think like a quant, even if you're trading manually. This is the real edge in trading, and it's available to anyone willing to develop it. Drop a comment. What's your biggest psychological challenge? Taking losses? Following rules? Managing risk? Let's talk about it. Thanks for listening.